Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about something that's pretty dear to our hearts because something that we think we can add a significant amount of value in regards to. And it's something that we think a lot of accountants don't take the opportunity to add significant value. And the reason for that is that most accountants are really busy sort of chasing their tail, putting out spot fires and dealing with a lot of workload. And as a result, they spend most of their time thinking about, what happened last financial year, preparing financial statements, returns, all those sorts of things. But we think that there's a lot of benefit of, just putting our pens down and having a conversation about, okay, what does this year look like? And what's our plans for this year regarding profit distribution? And, sometimes there can be things that we want to do before the end of the financial year or even during it to make sure that we're going to be in a great position to maximise outcomes. And if you don't identify those opportunities proactively, you're sometimes thinking about it after the end of the financial year, there's not much you can do about it to rectify it. And you might already by that time be into or through most of the subsequent financial year, so you're almost sort of 2 years behind, if you like. So we think there's a lot of value in having that proactive approach. And today we want to talk about, what are some of the things that we think about? Now, of course, everyone's situation is going to be different, and there's always idiosyncrasies and specific considerations. So none of this is ever sort of tax advice. It's just information, of course. But what we thought we'd do is just think about some of the general considerations. But of course, you need to get specific advice. So the first thing when framing a profit distribution strategy is to really think about the client's individual or personal financial goals and lifestyle needs. So, of course, we can sit down and design a distribution strategy that results in the lowest overall tax. But if that means that profits are trapped in entities and can't be used for personal purposes, then it really doesn't align to the clients. So one of the key things we want to be thinking about is what money does the client need or should need? So it goes to things like, how much are they spending on general living expenses, travel, these sorts of things on a year-by-year basis? Do they have a lot of tax-deductible expenses in their personal name? Now, that could be things like negative gearing associated with property investments or really any geared investments. Could be donations, these sorts of things that are going to create taxation deductions in the individual name. Super contributions is another big one. And then also, what about their future plans and goals? So things like, do they have a really large home loan? Because if they have a large home loan, particularly with current interest rate settings, it's costing them 6-ish%, let's say, per annum. That's an after-tax cost. We want to try and minimise that as much as possible. So getting profit out as tax effectively as possible into our personal name so that we can put that cash in an offset account or repay the home loan can be, really advantageous. And so that's where we need to make sure that our profit distribution strategy very much aligns with the personal and lifestyle goals of our clients, and having that conversation is critical.
And I'd just like to add on that, it's also important to consider why you should get profit out of a trading entity. And it's a firm stance that we have within our firm that your trading entity shouldn't have an abundance of retained earnings in there. And the main reason behind this is because of asset protection. Now, if your company holds on to a whole bunch of profits within the company, and it's great you're only paying 25 or 30% depending on whether you're a small business or not, if any of your suppliers, customers or anything like that sue you, all those retained earnings come into question. That's why you should periodically declare dividends into your family trust and then subsequently into a corporate beneficiary or into individual names to mitigate that risk. It's still, I think we've come across a lot of accounts that where, clients might be in very highly litigious or high risk businesses, and yet they've got an abundance of millions of dollars in retained earnings. And for us, that's a big no-no.
And you should be able to get those profits out of that trading entity in a very tax effective manner. So, you should still be able to sort of minimise tax and also protect those assets. Okay, so once we've then determined, okay, we want to make sure that we pull the profit out of the trading entity this year, and we've had the conversation around, okay, how much does our client need or should they have into their personal name? We then now need to think about, okay, how much are we going to distribute into personal names? How much are we then going to put into entities, super contributions, these sorts of things, which we'll talk about, some of those considerations. Let's start with personal names. And I guess the first point is that we want to have a structure that allows us flexibility on how much we want to put into personal names. And when I talk about personal names, it could be, if you've got a spouse, it's you and your spouse. If you've got adult children, it could include them. If you've got self-funded retiree parents, it could include them, for instance. If you have other members of your family that you can distribute to, it can include them. And we want to have that flexibility to be able to spread profit amongst several sort of individual taxpayers, if it's appropriate and if we're able to do so. But typically we're talking about, husband and wife, spouses, if you like. And so the first thing we want to think about is then, as I said, we want to have that flexibility to distribute into individual names. So paying yourself a salary, for instance, in a company, that might be appropriate in some circumstances, but then it really locks you into receiving that particular income. So again, we want to think about, do we pay ourselves a salary out of the entity, or should we wait to the end of the year and pay a dividend, for instance? Now that needs to be explored. The next thing is about how much. How much do you want to sort of take out? Some people will go, well, let's take out the minimum because, that means we pay less tax. But actually, that's not really an efficient way, because you'll end up in a situation where you're going to have potentially trapped profits. And the longer you leave it, the fewer years you have left in your lifetime to spread that tax burden out over many financial years. So we think it's prudent to make sure we take some money, maybe not a huge amount each individual year, but we don't necessarily want to minimise it because we think that's not going to optimise outcomes. So, for instance, an individual can earn up to $135,000 in any one financial year before their tax rate increases to 39%. So the tax rate under $135,000 is 32%. We think, tax can very rarely be avoided, only delayed. And in the long run, most people are going to pay an average tax rate, most higher income earners, are going to pay an average tax rate of around about 30%. So I think that's what you need to make friends with, that you're eventually going to pay 30%. Now, you might be able to go through a number of financial years and pay much less than that. But what I'm saying is all you're doing is create a compounding problem. And it means in the latter years, you're probably going to be paying more than 30%. So you can take up to $190,000 and your average tax rate ends up being 29.2%. So we think most people in business, if they have sufficient taxable income, taxable profits in their entities, that we think most people should be taking somewhere between $130,000 and $190,000 in personal names, even if they don't need it necessarily in their personal names, because we think as an ongoing long-term profit distribution strategy, that helps sort of minimise tax. If we do need to take a lot more money into personal names, and a common scenario is when we've got a very significant non-tax deductible home loan, then we might have to, we're forced to take more, right? Because otherwise we might create Div 7A issues and the like. But even if you take up $220,000, $230,000 per year, the average tax rate that you'll pay on that income is about 32%, which again still aligns to that sort of long-term average that we're aiming for, being around about that 30% mark. So I think what we've seen in the past is that accountants can become really too focused on tax. As I said, it doesn't necessarily then give you the ability, all you're doing is compounding a problem because you're just creating more taxable income to distribute later on. And we think a more longer term approach towards tax minimisation tends to yield the best benefits or the best outcomes. So that's kind of some of the things that we think about when thinking about individual sort of tax distributions.
And another thing that is often not considered is that sometimes accountants try to avoid the $250,000 threshold, i.e. Division 293 tax threshold. Now, for some clients, they might have a significant amount of negative gearing in their personal names. So sometimes it's more favourable to actually pay the Division 293 tax of the 4,500 odd thousand to just get the most benefit from those negative gearing, because that could get up 47%. So it's really important to also not just try to avoid tax altogether, but understand the entirety of the situation. The next thing we typically consider is Section 100A and distribution to family members. Now, we've spoken about this a couple of times in our podcasts. Now, when we determine or when we want to make distributions to family members who are outside of spouses, if the physical distribution is not made, then we fall short of Section 100A legislation. And what that means is that the trustee can be assessed on that distribution at 45% tax, which obviously is quite a considerable amount. So it's really important to understand how Section 100A works when wanting to make a distribution to family members. Now, sometimes those distributions can be offset by, for example, expenses that you pay on behalf of your family members, such as, groceries, living expenses, rent, aged care, and the like. So it's really important to actually keep tab of what you make in terms of consideration for, parents or children. It could be subsidising education as an example, to offset these Section 100A considerations.
And it's good to talk to your accountant about this, because then you can workshop ideas in regards to this. And I need to be very delicate in the way I'm describing this, but so I'm not suggesting that you manipulate the system, of course. But this is where, we spoke about last week about, taxation of trusts and so forth. This is where it sort of comes into play, is that you would just want to be quite strategic about it.
And finally, regarding trusts, sometimes it's better to actually retain profits in trusts just to avoid the Division 293 tax, again, depending on your personal situation. So, for example, we might just distribute the 180, 190,000 to the beneficiaries, or even up to 220, 230, depending on the personal situation, but retain the balance of the profits within the trust, just because you'll be paying 45, 47% either way, but you avoid the Division 293 tax of the 4,500 odd thousand. So it's another consideration when determining your profit distribution strategy.
And the final thing is using a corporate beneficiary, which was spoken about many times in this podcast before. So that's where we've got money coming out of a family trust and we can distribute it into a non-trading investment company, for instance, and then use those funds hopefully for investment purposes. When we make distributions to a corporate beneficiary, we've got to think about the physical cash transferring. Now, that doesn't necessarily need to happen immediately in that following financial year, but once that subsequent financial year is completed, then it becomes a potential Div 7A issue. So that means that if we've made a distribution to a corporate beneficiary, but we've used the cash for personal purposes, then we need to put that money on a loan agreement. But we try to avoid that wherever possible. And this kind of circles back into talking about the personal distribution strategy and our view that you should try and, you don't want to aim for an average tax rate of 30%, but if you have a very high taxable income, your business is doing well, for instance, then I think you've got to make friends with that potential outcome. And so this sort of cycles back in through that to eventually trying to get the money into your personal name and spreading that over many financial years. So for some people, we say, okay, well, we're going to distribute into a corporate beneficiary. And by the way, you've got a lot of surplus cash flow. So let's invest some of that cash flow over the next financial year. And we might do that, for example, on a monthly basis, so that we know then at the end of that financial year, we can make a distribution to that corporate beneficiary and we don't have any Div 7A issues because that money is already landed in that environment, which is going to be a really tax effective environment to invest in. So I guess that leads me into the point. It's great to come up with a profit distribution strategy, but that's only sort of half of the equation, isn't it? The next part of the equation is then what are you going to do with that profit and how are you going to build personal wealth and making sure the answers align. So where the money's going to end up, that entity or that ownership structure is also a good place to invest or whatever you might do with that money. If you're going to, for instance, go and buy another investment property this year, then we might change our focus and say, well, that means we then expect, hopefully, more negative gearing in your personal name. We can make more distributions into your personal name to soak that up. So that's where, that long-term profit distribution strategy, you need to think about, long-term outcomes. You need to think about what is your investment strategy. You need to think about what is your personal situation. So there's a lot involved in this, and you really need to be proactive. Not in every circumstance. Sometimes it's quite simple and you don't need to do too much. So we don't want to, overcomplicate it where it's not necessary to do so. But having that conversation, that proactive conversation, gives your holistic accountant the best opportunity to add value. Okay, a little bit longer today, but it really is an important topic that we spend a lot of time on internally. So we just wanted to share our thoughts with you. And until next week, bye for now.